G'day and welcome to the Investor Motivation Podcast. Today I've got myself, Rob Goudie, and joining me is Ash Rowan. And Ash, working out of Melbourne since you moved down about this time last year. How are you, Ash?
Yeah, good mate. Happy New Year. This is probably your first chat for the year.
Yeah, absolutely. 2026, and we are into it. You got some time off, Ash?
Got some time off. Yeah, fortunate enough to head to a industry event today. We're going to a bit of a networking thing, but heading to the tennis afterwards. Where what are we first week into the tennis? So
Yep,
my first experience of the tennis, mate. So I'm looking forward to that, and the weather's supposed to be beautiful. So
that'll be great. You'll learn a lot about investing at the tennis.
that's it. Yep.
Yeah, fantastic. Are you hoping to see someone or just more of a social event and networking?
Oh, to be honest, mate, I think it's just a networking event
Yep.
and a bit of a look around the tennis itself, mate, and to see what it's all about. I've watched it on TV like we all have over the years, but
Yep.
never actually attended a tennis
Yeah.
match, so I'm looking forward to it.
I think there's as many people outside socialising that they're in actually watching the tennis from what I've seen in the past. But enjoy your day. So
Excellent.
what we're going to do today is really just go through, as we've been doing, is a case study each. We were going to go through a couple of case studies, but it turns out there's so many questions that come out that we fire at each other that we'll do one case study each and have a conversation around that and just see where it leads us.
Perfect.
Good.
Good format.
Yep. You're keen to kick off first, Ash, on this one, or would you like me to
Yeah.
go?
No. Listen, I've got one in mind before I forget it. I guess
Yep.
this is one I had a client conversation through the weekend, and as we do, mate, whenever there's a question popped at us from a client, and wherever we're diving deep into the strategy, we'll put a bit of educational content out there. So I did a short video on TikTok around this, and
Yep.
it stemmed through a lot more questions from that. But it's a good topic for us today. Now, this evolves around what happens from a social security point of view, and even extends onto aged care fees. That if you're a member of a couple, and if one person passes away, how does that impact entitlements
Right.
and care fees? So there's a bit of a trap. Let's say call it a trap. There could be a bit of a risk of losing a lot of benefits or benefits completely.
Yep. So we'll go through the Centrelink's social security side, and obviously I've always been really mindful of couples compared to singles, but there's a significant there's trap or downside when it comes to aged care as well, is there?
Yeah, well, I'll start off with the aged care side of
Yeah.
things. You know, there's an income and asset assessment completed front end to work out, will you receive a lot of government support in terms of payment of your fees? And that's called a supported resident. But most people go in as what's called a standard resident. And just for those out there, if your assets exceed approximately $210,000, you're a standard resident. So most people fall into that category, particularly if you own a house.
Yes.
In relation to that, and here where the trick lies, a couple of the ongoing fees for aged care are means tested. And when you're a member of a couple, your total assets are divided into two evenly,
Yep.
and your half share is then calculated, your fees are calculated based on your half share.
Yes.
So in this situation, Rob, where you're a member of a couple now, you're a widow and you're the surviving spouse, what was 50% shared across two people is now 100% yours,
Yep.
and your fees are going to go up exponentially. So there's a bit of a risk there.
Yes.
And also, mainly on the age pension as well, but definitely aged care.
Right. Okay. Yep. So obviously the one that I've been always very well aware of, and I'll get you to explain, obviously going from a couple age pension to a single, and why we're pretty hyper vigilant, making sure that the future, whoever outlives their spouse needs to be looked after, and we're pretty mindful about that. Would you be able to, I suppose, explain from firstly, we'll talk about the assets test, what happens there from couple to single, and then we'll lead on to, obviously, the money, the income, what happens to that as well, Ash. But let's start with the income first.
Um, so from an income point of view, we're talking about the age pension.
Yes.
There's likely going to be a reduction. I've got some thresholds here for you. I won't go into too much depth. There's a lot
Yeah.
of thresholds when it comes to Centrelink, and I often refer to this cheat sheet. So if anyone's watching and not listening, I've got it here in front of me here. Let's just look at the homeowners, and we'll go from a couple. A couple homeowner can have, I think it's up to $1,074,000 worth of other assets, excluding their house,
Yep.
and still remain eligible for the minimum rate of age pension. Now, the minimum rate is approximately, excuse me, $50 per fortnight, because you may be entitled to $1 of age pension, but you're then also getting the supplements on top.
Right.
So that'll cut out after 1,074,000. This is where the trick lies, that if you're a single individual and own a house, you can have up to, I think the number is $714,500 to be exact at the minute.
Yeah.
So that's, what's that, Robert? Nearly $400,000 less in
Yeah.
assets before your pension cuts off.
Right, so huge disadvantage straight off the bat when it comes to the assets. In terms of maximum age pension, what are the numbers there, Ash, just to give people an idea to get the full pension from it? And we're going to focus on the assets test more so than the income test, because there are two tests, and Centrelink will take the worst outcome. But generally, most people are asset tested, Ash, by far.
Yeah, if you're newly retired, oh God, let's say you've reached age pension age and you're still working part-time as an example, and you're generating some good income,
Yes.
there's chances there where you'll be income tested because you've got a wage and a salary still coming through. But the majority of the time, we're dealing with a reduction by the assets test. So you're quite right in that respect. So
Yep.
when it comes time, if someone's getting a part pension or no pension, we're looking at asset reduction strategies in order to get some benefit there for the client. But back to your question, mate, in order to get the full rate of pension, now, for a single individual, that's almost $1,200 a fortnight or 30 grand a year. So we don't ignore that, of course. A couple combined can have up to $481,500 worth of assets
Yes.
and still get the full pension.
Yep.
However, if you're a single individual, you can only have up to 321,500. So once
Right.
again, there's a reduction in order to get the full pension. This is where people are getting caught out,
Yes.
and they're going through this big life change, which is quite emotional, understandingly, but they're also getting impacted from an income point of view a few months down the track once Centrelink's updated and all that's processed. So a lot of people don't expect that. So we've got to be mindful as planners, mate, that if, we've got to understand what income needs someone may have in retirement, and at that stage in life that they can still support those income needs based on social security, and if they've got any other investments, how do we generate income and maximise returns?
Yep. Now, let's just move across to the income, the actual age pension paid. What is the maximum for a couple? And this is, I suppose, the scenario that Way's worried about, is that, couple getting the maximum, someone dies and it drops. What's the maximum for a couple? What's the maximum for a single?
Okay, so if you're in a couple arrangement, you can have up to approximately $23,000 each, so $46,000 a year as a maximum.
Yep.
That if you then fall down to a single category, the maximum is just a smidge over $30,000. So you go
Right.
from 46 as household income down to approximately $30,000.
Cool.
So,
And that's why we worry about the widows and widowers, that, if they don't have any other cash reserves, and this is when we do our projections, we want to make sure there's some left for whoever is left, because people can run a house very cautiously on 46, but if you want to see who's struggling in our community, it's often the widowers and widows that are trying to live, run the same house, run the car, turn the same lights on. Like, costs don't drop by half when someone passes away, and you're
no,
trying to
that's
do
right.
it off 15 grand less.
Exactly right, mate. Yeah. So that gets the mind thinking as planners, mate. What do we do to sort of protect that income stream, and making sure that we talk then about, okay, the maximum pension being $30,000 per individual, and those still struggling under that scenario. Well, there's a lot of cases where they're going to get a reduction in age pension because the assets are now fallen onto one person and your thresholds change, so they may not be entitled to that 30 grand.
Yes.
So what we're really thinking about as advisors, how do we maintain the maximum pension where we can, or increase it where we can? And we often use the estate as a bit of a mechanism to transfer assets around without disadvantaging the client from a Centrelink point of view. Now, where I'm getting to with that is, if you give away any assets in excess of $10,000, Centrelink will see that as a deprived asset, and it'll still be classed against your assessable assets for up to 5 years.
Yep.
So if all of a sudden we've got too many assets and we try and give them away, well, it's not going to really benefit the client for 5 years. So what we do, In some cases where we can, mate, is, and particularly when clients are retired or maybe in their, let's say, mid-70s, we start to really think about, okay, what are their estate planning objectives and how to ensure that, we can generate the income that they need for the rest of their lives, and even more so if someone were to pass away. So the point I'm getting to here is we can actually update the wills to assess whether it'd be more beneficial that instead of the surviving spouse inheriting whatever assets that may be in one individual's name, is it worthwhile that the next generation or maybe the grandkids or whoever would be more beneficial to inherit that rather than the surviving spouse, where all these assets are just laid up into one person.
Right.
So this is a way we can transfer assets around without any sort of Centrelink consequences when it comes to those gifting and deprived asset rules.
Right. Yeah. And for that to work, money that's invested in it need to be a willable asset. So joint accounts, trust, superannuation, that doesn't work. It needs to be a willable asset. So shifting assets around to make sure they're in the right ownership structure, that it can form part of the will, would be vital. And obviously making sure that whoever's left, you can't leave them with nothing and gift it all away. And of course, you don't know who may pass away first. So there's you got to make sure whoever's left is still got enough. And how would we prove that they have enough, perhaps, Ash, in terms of making sure that pension plus extra income, so they've got a life and they're not living miserably. How would we prove that?
Yeah, we've got vital resources that we've got access to as part of the business, like, Rob, where we do these long-term cash flow projections, which, sort of take into consideration age pension outcomes. So a big part of our job, particularly when we're meeting with new clients or even reviewing existing clients, is to do the modelling and do those projections to say, yes, you remain on track. So what we try and do, and I do this a lot for aged care, is we model different scenarios. So if we're if the estate planning is the main priority here and we need to move some assets around in the event of death, well, we're modelling these scenarios prior to doing anything. So we know that if a particular path was to then, be, go down that path as an example, then we know what financial outcome is going to be there.
Yes.
So this is all the work done front end.
Yeah, fantastic. Well, very interesting, Ash. I think some of the keys around this is making sure that we're having fun today, and we do that by proving that via projections, but also looking after the future, our future selves and your clients in the future. That as a couple or a single pensioner, that there are safety nets and that they are looked after, and we prove it via the projections.
Exactly. Yep.
Yep. Fantastic. Very good, Ash. I reckon that's a very interesting case study, and just I suppose one, that people need to be mindful of, and and plan around. Now, I had a chat with. This is not talking about retirement or aged care. This is well before that. Talking, young couple, very young family, lots of little kids, household income of about $150,000, and just over a couple of $100,000 in a home loan. So going pretty well. There's no tax problem. They're not paying, as individuals, not paying over 32 cents on the dollar. Employed people, so in pretty good shape. Your wife working part-time, husband full-time, and that works with the age that the kids are at. And this was, I suppose, one of my biggest bugbears of, the finance world or the property spruiking world, is that the accountant said, hey, you need a negatively geared investment property, even though there's not particularly a tax problem, and was referred on to the property people. And of course, they're talking about paying less tax, which is attractive to everyone. But here's the kicker for me, that the recommendation was to buy an investment property with 100% debt, because that's there's no deposit here. They use the equity out of the current home, where they're quite comfortable at the moment from a cash flow point of view, and recommending a property worth $750,000. So plus costs, they could be up to $800,000 in additional debt. And in my mind, I'd think, this is so risky. This could just change their lives and from balance, time, paying down their loans, and all of a sudden their debt goes up by 750 to 800 grand on an asset where they're deliberately going to lose money. And
Well, what's the motivator here? Sorry, Rob. Why if you went to see an accountant and they recommended such a strategy, why would the accountant recommend that? I know they're giving tax advice, but is there any real benefit there for the client?
well, I suppose there's biases that have formed over the last 30 years where a lot of people that have bought property here in Australia, that it's gone up in value. So even if you lose money, it's gone up. So there's that bias that, there's this thought process in Australia that you just buy any property and it just continues to go up and up forever. And I'll touch on my thoughts on that, which people probably know that have seen a bit of my stuff. But accountants quite often, so they have that, I suppose, those biases around returns. And then, they've spent their academic world to be trained to look for tax deductions. So if you're negatively geared, that's a tax deduction. So if you lose a dollar, and in these clients' scenario, given that you're not paying high tax rates at all, neither of them earn over 135 grand. So their highest tax rate is 32 cents. So in this scenario, they spend a dollar and they save 32 cents. They've still lost 68. But accountants love tax deductions. Oh, you paid less tax. And then, of course, the property people, and in a cheeky way, I said, I bet they suggested you buy a new property because the depreciation is higher. And they go, yes, that did happen, Rob. And I said, well, let me explain what depreciation is. That this is reducing the cost price, from a capital gains point of view, but this is the curtains and the carpet and all the things that are getting older that will need to be replaced at some stage in the future. So from an accountant point of view, absolutely, that, here's deductions, depreciation, it reduces the ultimate tax you pay, but this all comes at a cost to cash flow today, and the depreciation one is a future issue that, one, you've got to replace stuff. You get good tenants, bad tenants, or no tenants, which is not an issue no tenants is not an issue in Australia at the moment. So I'd say that's the biases or bits of conflicts that an accountant often has. But I mentioned that obviously what's happened in the past forms our biases, which is understandable. So many people have made money out of owning property, but the driver to it has been the amount of money that the banks have been allowed to lend to the average Aussie, and those levels now are very high. It was only 15 years ago the average home loan might have been 300 grand. Now it's 700 grand. These are huge numbers, and there is stresses. And I suppose you say, well, what's the conflict from the accountant? That was my thoughts. What's the conflict from the people selling the property? Well, they're in the business of selling property. That's the only thing they have to sell. So it's like going to a barber and saying, do I need a haircut? We know what the barber's going to say because there's only one thing to sell.
So regardless of if they think the property prices, may increase significantly over 12 months, 24 months, whatever the returns may be, they're just interested in a transaction.
Yeah.
They don't mind if the investment's good or bad once you own it.
Once I own it, once it's sold, they've made their money because they're, and as you know, I'm a big advocate from an investment point of view to, own businesses. Whether that's your own business or whether that is, that is a business that's listed on the stock exchange like Visa or Microsoft or Meta. And these assets are overvalued at the moment as well. There's been a huge run in share markets. So, but the higher up any asset goes, whether that's a share market, whether that is cryptocurrency, whether that is Australian property, the higher up it goes, our future expected returns go down. The risk becomes greater to be buying in at these levels. But in Australia, there's just this mindset that it just doubles every 10 years and you can nearly lock it in. And it's as though it's some sort of risk-free thing to do. And 750 grand worth of debt this is the bit, yeah, it's not risk-free. And it really worries me that young people's balance of life, their cash flow, is
Just
compromised.
based, just based on that, Robin, I'm probably, yeah, sorry if you're getting to that in a moment. Just in terms of cash flow, when the accountant sort of explains this scenario, is there projections done to explore that, okay, well, you've got an investment property, you're likely going to rent it out. Is the rental income going to cover the borrowing expenses? I know we've got to pay back monthly interest. So there's a deficit there. Now, what happens, you're talking about a young couple, young family. What happens if there's more children and someone needs to go from part-time back to casual or not work at all, one of the spouses? All of a sudden, there's significant cash flow pressures with that arrangement, and you might have to make an immediate decision to redeem an asset, and we all know substantial costs involved with that. Yeah, are these situations been explained by the accountant?
Well, by the accountant, all the people selling the property, that that they do go through, I suppose they go through the tax saving as far as I know. But the one thing that I said to the family, I said, well, part time while the kids are young makes a lot of sense. You still got your hand into work, which is lovely, and but I said I could nearly, there's a 90% chance you'll have to go back full time, or
Yeah, yeah, yeah.
because it'll be negatively geared. So I just know there's the mindset that all this is risk free, but it's risk financially because there's debt, and it's negatively geared, which means you're losing money, and it's a risk to the lifestyle. And I'm really got I suppose a mindset that whatever age group or season of life that we're in, we can look back and say, "God, I've got no regrets about that. That was fun." And too much debt is a problem for a lot of people. In the past, over the last couple of years, I've spoken to doctors on 450 grand worth of income that have cash flow problems because
Yeah.
of the investment property portfolio that's negatively geared with 3 mil worth of debt. Now the accountant's over the moon with tax deductibility, but the cash flow for the accountant is smoked, and it affects their lives and the stresses.
So what's your unbiased suggestion, Rob, that if someone's had a conversation with an accountant or someone selling property and they've discussed or went to a seminar or webinar and discussed these opportunities and are considering going down this path, what's your sort of unbiased advice to say, okay, well, this is what you need to consider prior to committing?
I think you need to understand the levels of risk. For me, this is all about education. We need to understand what has driven property prices in the past, and can those same drivers, and I'll cover off on a few of those, can those same drivers as happened in the past, can they happen again? Is it, so let me give you an example. From the 90s, interest rates have gone from in mid-teens down to where they are now, which are low. Not as low as COVID, but low historically. And households have gone from predominantly one household income to two. This is why childcare centres are chock-a-block here in our small town, and there's a new one being built and two more in the planning, I believe. This is because families, husbands and wives, don't get a choice. Can a household go from two household incomes? Can there now be a third and a fourth? So that can't happen again. And when you look at the other drivers, inflation, wages growth, and rental growth, they are lagging utterly. The only thing that's sort of, when you look at the two graphs, the only things that the average value of a home in Australia is in lockstep with the average debt.
Yeah.
And so getting independent advice, or at least finding research to understand the past, because any asset, and this is, we can find many examples of this, any asset that's been driven up in value, not by its profitability growth, and say Microsoft, for example, since listing since '86, it's gone up in value by over 400,000% in growth. That's been driven by profitability and as they reinvest and grow. But any asset that's been driven by the amount of debt that people are using to buy it, and farming land here locally is that as well, that it's been driven by debt, and that's where there's so much risk, and people are discounting it, and the people that are selling the property, of course, are completely conflicted. They've got one product to sell, so
Rob,
you need to seek independent advice, get decent research, which is for the average person probably not easy to find.
Rob, would it be fair to say that if the banks tightened their lending requirements and weren't willing to lend as much anymore, that would then stop the potential increase in value of these investment properties?
100%, because
Yep.
what do young people do? They go to the bank and they say, bank says up to this level, and they go, great, and they go out and then get disappointed because they go to that level because they're forced to go to that level. This generation behind me of first home buyers have been screwed by the government being complicit, allowing the banks to lend as much as they have. And obviously APRA's come out and put the brakes on a certain area of the market where you can borrow no more than 6 times income. I think you may have seen some of that, Ash.
Yeah.
So you're quite right. That's my theory on it, at least, that there is a cap and a ceiling to how much people can safely fund and have any type of life.
Probably one last question from me, Rob, and thanks for explaining that. With that client situation that you explained, not a young couple, what's potential there alternative? Like everyone at that age, or everyone through their working careers is motivated to generate wealth and assets and live comfortably. What would be their alternative?
Yeah, thanks, Ash. It's yeah, I can be very negative on this property piece because of the debt and the lack of diversification. So I've got to have an alternative, and the alternative is, and everyone's saying, "Oh, Rob's just going to say superannuation." Well, super can be a part of it, but there is no, it's not all or nothing. It's not superannuation or nothing. It can be super. These people may want to retire prior to age 60 when you can access super. So let's set some planning around saving some tax by putting an extra bit of money into super, not smashing their cash flow. We set up an investment portfolio. We may use some of their equity in their home, but some of it we could start with 20 grand. You don't need to go into 700 and 800 grand worth of debt. And we start to invest outside of the super environment and to invest into businesses, like I said before, Microsoft, high quality businesses. And these sectors outperform property substantially. It's generally the leverage that people love that means that they can have a small amount of money and multiply that. But that's all good when the market goes up. So superannuation, non-super, have a plan to say when is your home loan going to be paid off. And do those 3 things also mean that you've got enough cash flow to have fun in the present day. So when you look back, when the kids are all adults, like these rats, that you say, geez, we lived well and we were comfortable and balance was good. I think it was a quote from Rach in our office saying, well, it's, living half a life, saving so hard, for some future retirement that's not there. It's about balance. So it's no one size fits all. And again, like we said at the start, we prove these numbers with the projections. You're like, oh, lovely idea, Rob. Now we need to prove it as professionals to show that this will get them there. Yeah.
And what I found as well, Rob, to go along with that if the client's main goal there is to maybe get on top of their debt, surplus income can go towards paying off an existing mortgage quick prior to reaching retirement age. Then once the debt's fully repaid and maybe they're still working, at that point in time, we then just transfer that savings habit or that income into building an investment portfolio and fast tracking that wealth accumulation strategy, maybe in client when they're in their 50s or early 60s or something like that. So you still get the best of both worlds, but just get the timing right.
Yeah, it's interesting when, we've all heard on social media, that you've got to use the equity in your home. No, you don't. You can go to zero debt and then save your way to financial independence. I prove this all the time, but there's just this mindset that comes from people wanting to sell very expensive, lumpy assets like investment properties, because the conflicts, the marketing fees, they call them, let's call them commissions, are massive. Their incentives are huge. And when someone has paid off their loan, I'll say, well, okay, this was all after-tax money. Now we can do some, you're in your 40s or 50s, let's do some more superannuation pre-tax. This is how we'll save money. And you keep this $20,000 of extra cash flow. Well done, you've paid. And that 20 grand is to go and have fun while you're young enough and fit enough to do so. This is about balance. So,
sounds great.
Thanks, Ash. Awesome questions. I think all of a sudden we get to 30 minutes. Thank you so much for joining me. Have a great day at the tennis. It'll be epic, no doubt. And hopefully you'll wander off and find a spot you can actually watch some live tennis. Will be good.
Looking forward to it. Thanks, Gordon.
Thanks, everyone. Now you can find Ash on TikTok and Instagram and all those socials. Please be mindful of fake accounts. So Ash nor I, we will never direct message anyone first. You are allowed to message us, ask a question by all means, but just so you know that, we will not message you first. If anyone does that looks like us, it will be a scam, 100%.
That's right.
Cool. Thanks, Ash. We'll chat next week. Cheers.
Thanks, mate.